Hello and welcome to the second episode of Facts and Facts. This is a segment where I break down all the facts and insights when it comes to property investment, as well as respond to your frequently asked questions. My name's Kedge Collane. I've been investing in property for over 10 years now and helped countless others do the same. For me, this is all about helping lift your wealth consciousness so that you can make smarter investment decisions moving forward and help build a life of more financial security and freedom. In this episode today, what I'm going to be talking about is probably what is the most talked about topic in Australia at the moment, and is where are the interest rates heading? In this episode, very quickly, I'll just talk about what the rates are right now, and then I'm going to show some of the leading indicators to show where rates are likely to be heading. After that, I will talk about and give examples as an investor, how that will likely impact your cash flows. Then if you are looking to keep investing, I want to show you what kind of data points you should be looking at to help guide that investment. And then at the end, we'll just do a quick summary on all of that. So I'm sure everyone watching this, and most of you would know, at the time of filming in September, the RBA has increased by another 50 basis points. So the cash rate is now sitting at 2.35%. To explain it simply about what that means, it doesn't exactly work like this, but it means the banks will be borrowing the money at 2.35%, and then when consumers out there go for lending, they'll be repricing it and giving at about between 3.5 and 4.5, depending on what kind of loan and product that is suitable for your requirements, and that's normally how it works. So what you will likely see is every time the RBA increases their rates, what we're seeing is the banks are repricing their variable rates, usually by the same amount, and increasing it there. But sometimes, especially if you are refinancing or going to a new lender, sometimes you can still negotiate some sharper rates as well. So definitely something I would encourage. So the leading indicators that I mentioned, I definitely don't want to lose you here when I'm talking about this. So I'm going to keep it very, very simple and high level. So one of the leading indicators that shows where rates are going to be heading is what's called the Australian 2-year government bond yield. And more than the numbers itself, it's the trend that you want to be looking at, and you can kind of foresee what's likely to be happening. You can see here that the bonds started to increase back really in Feb this year, a little bit before that, and have been pretty much a steady increase all the way to the peak up in June. So we only had our first rate rise in May, and we've had 5 consecutive rate rises now coming into the month of September. So you can see here, going back in Feb, you can see how that's happened and how that has correlated to what's happening with the interest rates as well. Based on this, we can see here about mid-June, we kind of hit a peak around that 3.5% here, and now the rates have come down and starting to settle around that now 3.11%. So this is something I'm definitely be looking at closely in time to come, but based on what we're seeing, it looks like it's now leveling out. So what this likely is going to mean is that we're probably going to see maybe 1-2 more rate rises this year before we hit a bit of stability, and then I wouldn't even be surprised if we're getting into the back end of next year and we start to see the rates even come down a little bit as well. Another indicator to be looking at outside of the bonds is looking at here of how the banks are pricing their fixed rates. Fixed rates are a good way to an indicator to see what the banks are predicting in terms of the way the rates are going to go. Not that the banks always get it right, but once again, a great leading indicator to be looking at. So here you can see a couple of the big banks, Westpac and CBA. I've got here the 1-year, 2-year, 3-year and 4-year fixed rates. You can see both of these banks, the fixed rates are increasing year one. So using Westpac as an example, 4.59. Second year is going to 5.39. Third year, 5.69. But what's interesting is the 4-year is 4.89. Same way you can see CBA, 3 years 6.39, and it drops back down to 4.99. So this is indicating that the banks also are pricing that rates are likely to increase a little bit more, but then likely to come back down a little bit in the longer term as well. And that's what's being priced into these rates. Now, just an opinion that I want to give on what kind of rates to go for. Once again, not financial advice. Once again, can't do that. All I want to do is talk about a little bit about what I'm doing with some of my properties, as well as what I'm seeing a lot of other people do as well. Right now, on some of the variable rates out there, you're probably going to get rates maybe 100 basis points lower than what you're seeing on the fixed rates. So unless you really want that financial security and certainty about what you're paying, I would go with variable. And if you are a little bit fearful about what's happening, I would encourage you, just pretend like you are on a 4.59 or a 5% interest rate and just pay that extra into your loan. Because by the time those variable rates catch up to these fixed rates, if they ever do, then like I said, the amount that you're paying into the loan is likely to offset any gain that you would have had by fixing it. Once again, this is what I would do based on what I'm forecasting to happen with the rates, as I don't see the variables getting up to these numbers. But that will be up to you, and based on your personal circumstance, what you decide. Now, what I want to show here is a cash flow. This is an example of one I actually did for a client the other day. A real life scenario of an investment that someone was looking at in, this one was in Melbourne. So I won't go through the whole thing, but just the key numbers you should be looking at here. So this is a purchase price of $650,000. The rent based on current market is $550. Interest only product of 4.5%. So with this customer, you're looking at, in terms of cash flow, before any tax benefits, negative $1,326 a year. After you apply their tax benefits from depreciation and other deductions, they're going to be positive cash flow $3,328. So call it $64 a week. Now, what we've done is forecast in the future and added 100 basis points on top here, 5.5%. What we've also done in this forecast is we've increased the rent from 550 to 600 based on a number of other factors going on out there. But as rates rise, rents also do rise. So if you are an investor, I'll be looking at what the rents you're currently charging and having a look at what's happening in that market and look if there's an opportunity to increase. But also specifically here in the Melbourne market, seeing low levels of stock, we're seeing, I guess, the demand for rentals really surging. So once again, that $50 is probably conservative, but that's the way, I guess, we like to do things so clients can prepare for like a not worst case scenario, but a realistic scenario. And yeah, interest rate bumped up to 5.5. So rent's gone up to 600, interest rate up to 5.5. And now what that does is, before any tax benefits, the negative cash flow is now 4,170 a year. So looking back, so this one was 1,000, this one is now 4,170. The way the tax system is geared, what that means though is there's going to be a higher amount of tax that's able to be claimed back. And the net result, despite the rate rise, is that they're going to have a positive cash flow of $1,550 or $30 a week. So despite the rates rising that much, the effect on the cash flow is still quite minimal. So as long as it can be weathered during that time by looking at things like rent increases and knowing what this is going to look like, as an investor, the impact on the bottom line isn't that big. And just for argument's sake, if I did keep the rent at the same rate at the 550, then you're looking at this number would look at a neutral or just above neutral as well. So once again, like as an investor, impact you're looking at here anywhere between $30 to $60 a week as an impact. So that's what I'll be kind of costing in. But once again, it's almost a certainty to factor in that rents will increase. So it's only reasonable to add that into your calculation as well. Now, if you are still looking to invest, which I would definitely encourage from what I'm seeing out there right now, because of some of the uncertainty out there, there's some really good deals out in the market. And there's a lot of indicators to show why the long-term property trend is likely to continue. I'm not going to go into that on this video, but you can look at my previous episode and that kind of explains why. One of the factors I would be looking at, so this is showing on a macro level the amount the average Australian is saving as a percentage of their income. So this is part of the reason why rates are rising, to get in control of inflation. But you can see here that we've almost hit a peak and it's coming down slightly of how much disposable income that each person has on average. So you're looking at here almost 30%, now 29% of people's income can be saved. So what that means is that people have, on average, a nice big buffer in their households to cater for rate rises and inflation and stuff as it is currently. So what will then be good to do is take this macro level data of what's happening and then be investing in locations that don't have a lot of pressure on that market due to a high percentage of people of this kind of people. So this is what I want to show now is when you're investing, this is some of the data that we break down, but if you want to go out there and do it yourself, this is what I'll be looking at. So I've used a particular suburb here, lots going on, I know, so I'll explain. So this is a particular suburb that we spend a bit of time investing in. It's a suburb called Belconnen in Canberra. Once again, just using it as an example's sake. But what you can see here as a few indicators to be looking at. Number one, up in this top corner here, you want to be looking at the types of professions that people in the area are made up of. So using this example here, you can see a pretty large percentage, 37% of professionals, 11% managers. So you're hitting almost that 50% mark in really high-end jobs. Then, and that usually have a higher percentage of like income growth as well, as opposed to things like trades, which can be a little bit more volatile, particularly when the market is a little bit slower and people aren't spending. But another really good thing to look at is what the average earning potential of each person in this area as well. So you can, once again, you can see there's a real big skew that there's a lot of the people are on the higher income brackets in this location as well. And another really good stat is the one I've highlighted down here, is looking at what percentage of people in this area own their properties outright. So once again, using this example, 13% of people own their property outright. So you've got a portion of the market which is owned outright, so of course not going to be impacted by any rate rises. You've got 50% of people in really good jobs, a lot of high income earners. So once again, people that are going to be able to weather that storm aren't going to be forced sell, so therefore you're likely to have any declines in values. And once again, just for argument's sake, just with this example, even during this time, we have seen incremental price growth in this market, particularly on the affordable end, which is like, I guess, apartments over the last year. So what I would encourage you to do, if you're looking in, dive into some of this data, or reach out if you want to find out some of this data in certain locations, and then look at areas where there's affordability. So once again, with rates rising, people are moving to more affordable stock, and affordable stock in premier cities is once again what I will be looking at. We've got an influx of migration coming in. We've got housing shortage based on not a lot of new stock coming to market. People coming in looking for jobs. They normally want to hone in on areas where it's easier to get jobs. So if you kind of go into those kinds of areas on the affordable side that are backed up by income, that's the kind of area that I'll be investing in. So takeaway actions, for this is, if you currently already do have a loan, first thing I'll be doing is looking at either refinancing it or restructuring it in a certain way so that you can bring that rate down as much as possible for your scenario. There's a lot of banks out there right now that still want your business. They're giving cash rebates for you to do that as well. So a nice way to pocket 2-3K whilst you're doing it, and also getting the sharpest rate possible so your cash flows are protected. If you are an investor, I would definitely be looking at what the market rents in your location are across the board, across the country. We're seeing rental spikes and rental shortages, some areas more than others. So have a look at when your lease agreements are coming to an end and think about what a fair price to be putting that is. Now more than ever, I guess when things are a bit more challenging or there's uncertainty, I would say lean into your finances a bit more, create a bit of a budget and create a bit of a plan and have a look at where that is. And then think about what you can do to help your wealth creation long term as well. If you are in a position where you have a bit of disposable income, you've got a bit of equity or you've got a bit of cash, think about what you can do so that way 5-10 years in the future, you're building yourself some good income streams, so that way if things do happen in the world, you yourself are protecting yourself. For me, of course, I'm very biased towards property investment, something that I know and understand. Doesn't mean it's the only way. But if it is, as always, feel free to reach out to anyone in the team, and always happy to help. Otherwise, that's all for today. Absolute pleasure to discuss this, and I'll see you this time next week.